Hello and welcome to ET Now. You're watching IPO Central, and my guest today is from Solar World Energy Solutions. It's a EPC solutions provider for solar projects. The company's IPO is opening on September 23rd and closes on 25th. Price between 402 to 423. It's a fresh issue of 440 crores and an OFS of 50 crores, which takes the total size to 490 crores. And joining me today is Karthik Tetlia, who is the managing director of the company, and Rishabh Jain, who is the whole-time director of the company. Gentlemen, thank you very much for joining us today on ET Now. To begin with, Karthik, you are an EPC provider, but give us a brief sense of your business model and the revenue model that you have.
Thank you, sir. Thank you for having us over. Sir, Solar World is an EPC company. We do large utility scale EPC projects. Most of our customers tend to be PSU companies like SJVN and NTPC Green. We started in 2013. Today we are a very, very stable EPC company operating in this space. We work purely on solar projects.
What are the normal margins that you work on, because you're working with PSUs? Is the margins depressed compared to other players like in the private sector?
Sir, margins in our business tend to be around 10%. If you look at our numbers for the past few years, that is where we are. EPC segment in solar is not that competitive. It's a fast-growing market, and we have done quite well.
Rishabh, can you take us through 440 crores that you're raising? And my understanding is that you had a pre-IPO fundraise as well. So what is the amount going to be used for?
The primary raise is 440 crores, out of which 420 crores is going to get into pure cell manufacturing, setting up a cell line of 1.2 gigawatt. So the idea, the basic concept is to complete the value chain. As highlighted, we are primarily an EPC company, backward integrated into module, and the cell line will further add to the completing the entire value chain. And this will give us a better command over the the bidding process, as we are bidding for large ground mounted projects. So in the times to come, we believe that in order to beat the competition, as well as completing the entire ecosystem perspective, and also in line with the government regulations, we believe that setting up this cell manufacturing will add on to the bottom line as well.
Look at this entire competitive landscape, because you are a EPC, you're doing a backward integration into cells now. By when do you expect this cell manufacturing plant or unit to be ready and go commercial?
The cell manufacturing line should go live somewhere between December 26 to March 27. This is going to be a 1.2 gigawatt solar cell manufacturing line. Our module manufacturing line is about 1.5 gigawatt net output. It is already operational.
Give me a sense of your margins as well, because you had margins of roughly around 20% in FY25, and that's risen from nearly 14%. Where is this jump in margins coming from? Is it the module backward integration that has brought in margins, and whether and as and when your cell gets integrated as well, will it improve margins further?
Sir, as on March 2025, we were a pure EPC company. So the entire revenue and margin is coming from the EPC business. There is no module margins that have got added. The reason why you are seeing a significant jump in our PAT margins vis-a-vis 2024 is based on various factors. One of them being the type of projects we have taken up. So let's say if you do projects in Northeast, or you do projects which are very, very difficult to execute, and you execute them well, then your margins tend to be higher. And in the last year, our project profile vis-a-vis the year before that was different, and that has added to our margins. Going forward, sir, module and cell, because we are backward integrating and most of this capacity we will be utilized in-house, any margin that we were paying to module manufacturers and cell manufacturers right now for our EPC projects will definitely get added to our margins in the existing business.
was
So
the
we
kind
will
of,
definitely see a jump in our margins.
what is the kind of margins that you are looking at or you're paying to your module manufacturers currently or the cell manufacturers? I'm just trying to figure out the quantum jump in margins that could come in because of the vertical or backward integration of the entire process.
Sir, if you look at the market currently, and I can't forecast my own margins, but if you look at the current margins of Vari and INA or Alpex, which are currently listed in this space, you will see all of them are making between 12 to 13% PAT margins, which basically says the kind of margins they are making when they sell these solar panels to us for use in our EPC projects. When we start doing manufacturing ourselves, we are hoping to see somewhere that is what we would kind of predict should happen.
What is the kind of order book that you're sitting on, and are you going to diversify your risk from the PSUs to other players as well?
Sir, as on the date of RHP, our order book was close to about 2,500 crores. 1,900 crores as EPC business and around 600 crores as my best projects. We are definitely diversifying into more geographies. We are diversifying into bigger projects. We are diversifying into newer customers. So we will also add private customers to our mix going forward, and that is one of the growth strategies for the company.
When you mention best projects, which is battery energy storage systems, are you going to be setting up those, or you will also be manufacturing the batteries at some point in time?
We are so if you look at our RHP, we are already investing into a lithium cell to battery pack line. This line should go live very shortly. Again, this is a backward integration for us. We believe that government is now going to make battery energy storage a very important component of all solar projects. As a strategy, we want to become an end-to-end supplier to our customers, and we will be in a position to supply solar cells, solar modules, and lithium batteries solutions to our customers as a whole. So we'll become a one-stop turnkey solution providers to developers who are looking to set up projects.
What would be the capacity for you in terms of the lithium-ion line that you're going to set up?
So it should be in the range of 1.5 to about 2 gigawatt per annum.
Which basically means that while FY25 was mostly to do with the EPC business, it's in FY26 and 27 that your backward integration will come into play in that sense. If that is the case, how is the entire business model going to change for you?
Sir, as a strategy, Solar World intends to remain in the EPC business. We are a leading company in the EPC space and solar. The backward integration is to support the EPC business. So we are looking to grow in the EPC space and use the backward integration as one of the supporting pillars to see that growth in our EPC business. So going forward also, our focus is going to be how we can grow our EPC business. The manufacturing will help us de-risk our EPC business. It will help us in cross-selling to customers who are looking for solar panels, our EPC business to customers who are buying solar panels. So that way it acts as a very complementary thing for us to have this backward integration. And since we use a lot of this capacity in-house, we are not very affected by how the market is playing out within the manufacturers, large-scale manufacturers. So to answer your questions, we are looking to be a large-scale EPC player in this whole value chain.
You also have two models, right? One is a Capex model, the other one is the renewable energy services model which you provide. How is this model bring in revenues for you? Okay, if you can give us some clarity on this.
Sir, the Capex model is where we are only doing the EPC, which is the design, installation, construction and maintenance of the projects. RESCO projects are projects in which we set up the whole project and sell electricity to the customers. We have done some RESCO projects in the past, but at present I would say it is a very negligible part of our overall business. We are predominantly an EPC company. In RESCO projects, the revenue would typically come from the electricity that is sold in that particular year under a power purchase agreement to the customer.
What is the kind of capacity that you have in the RESCO project?
Capacity in the RESCO project, as I said, is negligible. We have about 2 megawatt, round about 2 megawatt of operating projects, rooftop.
Rishabh, if you can come in here and give us a sense of the kind of balance sheet strength with respect to how much of borrowings is there in the balance sheet, and what is when you're setting up this capex plan both for modules, cells, and then lithium ion packs, what is the kind of total capex that you're going to incur over a period of next 1 or 2 years?
So, sir, as highlighted, the entire object for this raise is to set up the 1.2 gigawatt cell manufacturing, and as Karthik highlighted that we would not want to stress on the existing business, which is a pure play EPC. So this entire 420 odd crores of capex, we look forward to investing this and setting up this line by between December 26 and March 27. So the effect of this capex will be reflected, from 27-28 numbers. So this entire proceeds of this raise should go into building up the cell manufacturing.
And what would be the debt on the books after this entire project gets completed?
Sir, so our as on date, as on March 25th, we had done a capex for our module manufacturing line. We had a debt of close to about 114 odd crores, including our working capital limit utilization. We were net debt negative. For our solar cell line, we are projecting a capex of 575 crores, out of which 420 crores will be funded through this fundraise.
Finally, what is the kind of margins that you foresee for yourself on a nominal basis? Because you said the jump in margin was because of the mix of projects which were coming from Eastern India. So of the total order book that you have, what is the kind of orders which are coming from Eastern India for you?
Sir, at present, I would say we cannot comment on the future margins, but at an industry level, I would say that the industry is operating at a very healthy margin of close to about 9 to 11% in the EPC business. If you look at the manufacturing business, there are a lot of listed competitors now who are making somewhere between 13 to 14% margin on their turnover. So, as a whole, if you look at the industry, it is very, very rapidly expanding and growing bigger to meet the energy needs of the country. And we expect that will also translate into the players that are operating into this industry.
Good. Karthik and Rishabh, it was a pleasure talking to you today. Thank you very much for joining us on ET Now and coming on IPO Central. Your IPO is opening on 23rd and closes on 25th. 402 to 423 is the price band and 490 crores is the IPO size. Thank you for joining us today.